Good evening, everyone. Thank you very much for joining this webinar this evening on savings and investments and just getting your money working harder for you. For those of you that don't know me, my name is Nick Charalambous, and I run a financial services company in Little Island in Cork called Alpha Wealth. I'm going to run through, I suppose, a few slides just for 5 or 10 minutes, just a few areas in terms of how we can get our money working harder. And then there's going to be some questions which we've assembled over the course of the last week or so. But just before I do that, I'm just going to give a few moments for people to join. But if you see a poll, I'm just going to launch. If you can, just maybe answer that. And one of the things I'd like to encourage you to do is please feel free to use the Q&A box to put any questions in that you'd like answered. We will endeavour to try and address them during the course of the session. If we don't get to them, we will certainly get back to you. And if anyone is interested in maybe getting the slides or indeed the video, conscious that some of you may miss part of this session, please do feel to reach out to us. The easiest way to get us is on our Instagram page or our website, or indeed email me, nick@alphawealth.ie. So just to get on, in terms of the company, we set up Alpha Wealth about 9 years ago, and there's 8 fully qualified professionals based in Little Island in Cork. We do have a small presence in Dublin, and we work extensively with individuals. And one of the things that we are offering on foot of this financial webinar is a complimentary consultation. Normally, these consultations cost €199 plus VAT. We have been providing an introductory one for €99, which basically gives you a sense of different areas of financial planning, whether it be mortgages, saving for your retirement, saving for your kids' education. And I'm going to touch upon some of these areas today, but there's no obligation to take any advice that we give you. So I'm going to just go into a few of these. And if you can see on the screen, we all look at different investment options, and there's various different things that we can invest in, whether it be property, looking at deposit alternatives, trying to reduce the tax that we pay, looking at providing some form of fund for our children, or indeed looking at the likes of cryptocurrencies and trying to be more speculative. And I suppose the main thing that we try and assess with our clients is what is most appropriate for them at whatever point they are in their financial life cycle. As all of you, I'm sure, are aware, the issue we have at the moment is that we have this low interest rate environment where the banks, post office and credit unions are really not paying any interest. And that's added to the fact that we're now suffering from inflation rates of anywhere north of 5%. That means if you have €10,000 sitting in the bank, this time next year, it's going to be worth 9,500. So the main, I suppose, dilemma for all of us is to try and at least keep our money where the real purchasing power stays at least equal. And we can't do that by leaving our money in the bank. Now, hopefully you can see this slide here, which is a really interesting graphic where we've done a little bit of work over the last while with some of our clients who are looking to save either for a new car, whether it be for their children's education, or indeed for a house or an apartment purchase. And generally the rule of thumb is around 30,000. And you can see here very visually that if you get an interest rate of approximately about 3.5%, that can be achieved from some alternatives to the bank. I'm going to touch upon one of these accounts slightly later, that it's going to take you anywhere between 4.6 to 13 odd years, depending on the amount that you can afford to save. So really, for anyone, what I say to them is try and start early, and then you don't have to necessarily be able to save as much. Anyone who can afford to put €150 a month away for the next 13 years will have achieved that form of return of 30,000. But obviously, if you're looking at a time scale of 4 to 5 years, you really need to look at contributions around €400 to 500. We've just set up our savings and investment club, and we've just set a savings challenge where if you can afford to put in a minimum of €100 a month, and the example given here is we're trying to get our clients to work with them to enable them to save €300 a month, that over a period of 5 years, they will generate a return of around 20,000. And that again is based on the interest that we believe will be earned And there is also a bonus where we're applying an extra 1% a year to these accounts for anyone who does sign up before the end of June. Again, please feel free to put any questions into the Q&A. And I'm just going to talk briefly about one of the plans, which is with one of the providers in the Irish marketplace called Zurich. We operate as an independent broker. Zurich, in my opinion, and I speak extensively about the fact that anyone who is saving for any purpose over 3 years really should look at this as an account. The minimum contribution is 100 a month. You have complete flexibility of payment. You can increase your payment, you can reduce it, you can put it on hold, and you can exit at any time without penalty. Now, some people listening back to this, either on playback or indeed are listening live, you may have this type of account set up already. And the key thing I'd always say to you is, do you know where your savings are being invested and what fees you're paying? Because a lot of financial brokers charge fees of 3-4% on every contribution you make. That's called the allocation rate. We would provide a 0% fee going into these accounts. I'd like people to see us as a low-cost broker, and we basically work on volume. So we place a lot of business with the insurance companies, and we like to engender good working relations with our clients. So the more that you make, the better we feel in terms of the engagement that we have with our clients. So just to touch upon this, one of the key takeaways from today is that whenever you're looking at money, whether it's invested in a pension, whether it's invested in savings, the chart of risk and reward, which is up here on the screen, goes from a scale of 1 to 7. 1 is your bank account, post office, credit union account. And the issue I have with these institutions is that they're only really geared to short-term savings. This is this cohort of 0 to 3 years. Anyone who is saving or has the capacity to save for 3 years plus should be looking at an alternative, because you're not going to make any interest, as I've said, particularly over the next 3 years. As you can save for a longer period, so for example, someone saving for their retirement, if they're in their 30s, has potentially 20 to 30 years. And on that basis, they should take more risk. So really the main, I suppose, theme of today is that the more time you have, the more risk you should accept. Now, many of you are probably aware that over the last 2 months, we've seen a bit of a pullback, particularly for anyone who has a pension scheme and maybe part of a work pension. And sometimes we have this, I suppose, knee-jerk reaction to do something, whether it be to change the funds, maybe de-risk. And the key thing is to understand where you are and whether it's worth staying the course. Normally, sometimes the knee-jerk reactions don't make sense. So what we're saying to people is just get independent advice. It's always great to get a second opinion and see whether you're on track. And I always talk about this roadmap. It's about saying to people, do you know in terms of where you're aiming for? I'm 48 years of age. I have 4 children. I run a business, and I have a very defined time frame in terms of what I want to get to. And obviously I map that out. And the key thing is that you review it annually so that you know whether there are any reasons that you should make any changes, whether you've had a pay rise, whether you've had a child, whether you have the capacity to do more, and more appropriately is make sure that you financially budget. We have a really good tool on our website. It's also on our Instagram page. You can download it for free. It's a financial budgeter, which works really well. And I say to people, you should endeavor to complete this once a year. It only takes about 10 minutes. If you have your mobile app open in terms of your banking, or indeed a month's worth of bank statement, just populate it. You feel free to share it with us. We can help you reduce costs on very different areas, including house, health, car insurance, and enable you to put the money away into the savings schemes that we would really encourage you to look at. So just to move on from that, before we get into the Q&A, you can see from the graphic here, anyone who's saving for their children, particularly over a medium to longer term, even if you put the child allowance away, let's say from the time that your child is born, that would accumulate to a return of around 42,000 euros. And that's based on a 3% net return, which, as I said, is only achievable in these alternatives to the bank. For those of you that may be looking to save for secondary school, or indeed maybe late in starting, you can see that even over a 5-year period, you can still accumulate quite a reasonable fund. Obviously, the lower graphic then shows with a contribution of 10,000, and if anyone has money sitting in the bank, they really need to consider whether there's a better use for it, because obviously at the moment, as we know, these amounts are not generating any interest. I'm not going to draw too much to. There's another alternative to pensions, which is called the EIIS scheme, or in the Employment Investment Incentive Scheme. And I just want to leave you with a very quick illustration that anyone who's suffering tax at the higher rate, typically for anyone earning over 36,800 a year, I'm going to give an example of someone who's earning 50,000 euros. You have the ability to invest money that you have personally into a government-backed scheme called the EIS scheme, as I mentioned, where the government will give you a rebate of your contribution, an example here of 10,000 euros, of 4,000 euros next year. The main difference between this and a pension scheme is that this is a 4-year plan, whereby at the end of 4 years, you look to get back your 10,000 plus interest of approximately 2,000 euros. What I want to do this evening is just give you a little bit of information about how you can better financially manage, giving you a kind of a menu board of some of the things that I believe that you should be considering if you're in a position where you have some money, or indeed if you're working with a financial planner in trying to reduce some of your outgoings, whether you should be applying your money towards reducing some loans. I had a meeting today earlier with clients who had money in the bank, but also had car loans. And I was saying to them that it would be much more effective for them to reduce their car loans down and then to put their money into savings vehicles such as pension, the Zurich Easy Access scheme, which is readily available, and indeed looking at tax alternatives like the EIIS scheme. And that's it. It's not particularly scientific. It's just about knowing what options are out there for you. So I'm just going to move into the Q&A piece of the session. But just to summarize, areas that we help people with are mortgage advice. We do not provide mortgages, but we definitely give guidance to helping people get a lower rate on their mortgage, the amount that they can save, and doing it with the least hassle possible without any bias. We provide independent protection reviews, pension advice, estate planning, children's savings, retirement planning, and the tax-backed scheme that I referred to. And really, as I said, what I'd like to be able to offer you is an opportunity to find out a bit more about how Alpha Wealth can service you. So now I'm just going to move into the piece on the Q&A. Now, as I say, we've had various questions come in over the course of the last week. If anyone would like to ask any additional questions, please do feel free, as I say, to please put the questions into the Q&A or indeed the chat function. Now, the first question that came through was, should I be investing my pension in a high or low risk fund? Now, I drew reference to this earlier when I said that it really depends on your age and the term to your retirement. Generally speaking, if you have a longer time to invest for, you should be taking more risk. And it runs on that scale of 1 to 7 in terms of where you should be positioned. The key thing to remember, though, is that you should never go down to a very, very low risk, even if you're very close to retirement, because the way that we draw our retirement benefits now enables us to invest 3/4 of the fund that we're left with when we do draw down our benefits to continue to grow and be invested. You can see a question's just come through in the chat. So somebody's asked, is it worth investing in the Espp, which is a share scheme through their company, which provides a 15% discount? And my general rule of thumb would be that yes, it is. Obviously, if you can acquire an asset, in this case, shares through your company at a discount, it will be sensible. Bearing in mind, they do carry obviously a level of risk. Now, the one thing I would caveat that by is saying that you should look to sell them when they vest. Typically, that's a 3-year period. And the reason I say that is because you should never accumulate too many shares in one particular company, particularly if you're working in that company, it provides too much exposure. And the second reason you should look to sell is that we can all avail of a capital gains tax allowance, which is 1,270 euros of gains every year. And some people basically see that if you are saving over a longer period, that you're going to accumulate quite a lot of shares and you won't have used that tax allowance over the course of that period. Now, looking into the second question, I'm looking to get a mortgage in the next 2 years. Which is the best bank to go with? It's a really interesting one, and there's no one-fits-all solution. What I say to every client that I come across, whether you're looking for a mortgage or whether you have a mortgage, is you really should be looking for getting a rate of down to around 2%. Avant offer the lowest rates in the market currently at 1.9, tending up to 2.1%, depending on what loan to value you have. There are other institutions such as ICS that are offering first-time buyers a rate of 1.95, but rates are varying and sometimes they change on any given month. So you just need to know how to navigate the market. But anyone who has a mortgage should look to their own bank. Some of the banks offer green mortgages, such as AIB, who, speaking to a client earlier who didn't avail of a green rate, was eligible for a green rate because they had a BR rating of B3 or higher. And based on one phone call, they were able to reduce their rate down to 2.1%, which was a huge cost saving without any hassle at all. And more importantly, is that they could fix for 5 years before interest rates started to rise. I can see there's another question that's come up on the chat. It says, many consultants run limited companies. Can we negotiate with staff instead of pay rises, pay to the pension scheme, that, or do they have to match euro for euro from their salary? No, there's no entitlement for a company owner to pay a contribution to a pension, but it is a very tax effective incentive. So in terms of Alpha Wealth, for example, as I mentioned, we have 8 employees. We use the pension scheme as an alternative to pay rises in some instances, and it's a win-win both for the employee and for the company. The reason being is that Alpha Wealth does not pay employers PRSI on the contribution that we pay to a pension, where we would with a pay rise. And secondly is that the employee gets full allocation into their pension, whereas if they're earning over the threshold of 36,800, they'll only see 48% of the pay rise. So it's really a case of what works well, both for you and the employee. But absolutely, it's a very sensible vehicle to use, particularly in relation to bonuses, where you can obviously give an employee a bonus and benefit from the fact that you don't have to pay employers PRSI and they don't have to pay tax on the contribution. With regards to one of the next questions that comes up, that came up earlier in the week, I have some cash and deposit in the bank and thinking of investing. What are the best options for me? Well, as I said earlier, there's really only 3 types of investment vehicle available. Your pension, the EIS scheme, and that's only really applicable if you're a high rate taxpayer, and the Zurich savings plan. I really like it as an option for people. And what I say to them is it's about balance. It's about allocating your money in the appropriate way between those short, medium, and long-term pots that I referred to earlier. And I think the key thing that a financial advisor can do is help you adjust those pots to make them meaningful for the time that you're going to need them. There's no point over-egging your pension scheme and finding that you're borrowing money then to pay for things like cars and indeed trying to fund your kids through 3rd level education. Another question that came up was, should I have serious illness or income protection, and what is the difference between them? Well, there's really 3 areas that you can insure for. One is the event of death, the other is if you suffer a serious illness, and the other is if you are unable to work through illness, injury, or disability, and you require an income to pay bills. Now, in my opinion, what we all need is a balance of the 3. Depending on whether you have financial dependence, you may not need much life cover. If you are the only income earner in the household, income protection is really important. And it's definitely worth assessing what benefits you have through your employment. I constantly have conversations with people who say to me, Nick, I want to look at, providing cover for my family. And I say to them, well, first and foremost, what benefits does your employer provide? If you're part of a pension scheme, it's quite likely that you may have some death in service, typically 4 times your salary. And also you may have some income protection where they'll pay you if you're unable to work. Some people don't know the answer to that. And just with a bit of clarification, I say to them, will you just check with your employer before we discuss this further, for how long will they pay you if you're unable to work? Because if they're going to pay you indefinitely, there's really no need for you to take out any further income protection. You cannot be overinsured. You can only insure for 3/4 of your salary, less the statutory sick pay. And it's worth knowing what you can be covered for. And these financial products, they have their place on the shelf, but it's about balance. It's about finding the right amount that you spend on these in comparison to the other things that you have. One of the main things that we definitely help our clients with is getting the right level of health insurance. We do not sell health insurance. We do advise our clients, however, and we really help them in terms of navigating what is a bit of a minefield. There's over 490 plans available. I have a plan with Leah myself. And one thing I can say to you definitively is that whilst I have 4 children, I've only ever paid for one of them. They offer kids plans whereby you pay for one child, get the others free. And it's a really big saving, and it doesn't in any way hinder the level of plan that you go for. As well as that, there are online discounts that are available. And whilst I've been a member of the same planning layer for the last 10 years, I've always availed of a 10% discount, but I've had to cancel and rebuy the plan every year. It takes me 2 seconds, but I saved myself 90 euros a year. That's a little bit of financial advice, I suppose, for anyone who does look at reviewing their health insurance every year. I see another question has come in just in relation to cryptocurrencies and who would you invest with? Cryptocurrencies are very high risk, very volatile assets. And I would say to anybody, you should tread very carefully. I have exposure myself. I suppose part of my reasoning for getting exposed to cryptocurrencies is firstly to educate myself, but also that it only fits a very, very small part of anyone's portfolio. You should never invest more than 5% of your overall portfolio in cryptocurrencies. Specifically to answer the question, there is certain sites that I'd be very mindful of. You know, you have to be very careful that a lot of cryptocurrencies that you see advertised are scams. Coinbase are a very reputable provider of these coins. However, you need to ask yourself, why are you investing? Is it to make a quick return? Because if so, that's really, really risky, and I wouldn't encourage anyone to do that. However, if it is a case that you just feel it makes sense as part of your overall planning, please do feel free to reach out to me. I have a lot of knowledge in this area. I've written extensive articles for various press, and I'd happily share with you some thoughts on it without obviously any obligation. There's another question just in relation to the increase in mortgage rates. If you have a tracker, would you change or stay on this? It's a really good question. Trackers were generally held as gold. You know, people would be afraid of their lives to move away from a tracker. But interestingly, because of the fact that we can now get mortgage rates tending to around 2%, as interest rates start to rise, which inevitably they will do, and we started to see this creeping in, obviously that will affect the tracker rates that we're on. But in order to answer that question appropriately, I'd need to know a little bit more about what the rate of your tracker is. Some tracker rates have only a 0.25%, for example, increase on the European Central Bank rate. So that's going to be a very favorable one versus some people who have a, say, a 1% increase on the European Central Bank rate. But again, you know, it's worth just, you know, talking to an independent broker and getting appropriate advice. But typically trackers are quite valuable. And the mainstay would be that certainly for the next 2 to 4 years, I would say on balance, it would typically remain that you should hold on to them. A question came through as well during the week around, is it necessary to protect my income additionally with an income protection plan? I've kind of answered this question already. Really, it depends. You know, some people are insured. Let's say, for example, if you're a public servant, where if you're a teacher, you're insured for 3 months full pay, 3 months half pay. Should you look to insure your income beyond that? It really depends on whether or not you know, you have a high enough income level, and that's again, you know, appropriate to making sure that it's going to be meaningful for you. And sometimes with these products, it's about finding the right product, but at the right price. Core Market, for example, would typically have an association with teachers and nurses. And I'm not going to be disingenuous to them this evening, but what I would say, and I'd say about any other financial broker out there, is compare what you're paying or what you're being offered to pay with someone else. And the key thing is to know, as long as they're independent. The problem I have with Core Market is that they don't provide that independence. It's the same if you go into AIB, who are tied to Irish Life. Same with Bank of Ireland, who are tied to New Ireland Insurance. And because they have a captive audience in all of those cases, they tend not to discount rates, and they don't fight for the business in the same way that a broker would, making sure that they offer the keenest rates available, and obviously the follow-up advice that goes with it. I see another question come through in, what is the longest fixed rate mortgage available currently in the market? That's an interesting question. Avant offer fixed rates up to 20 years, and that's why sometimes it's not just about getting the best rate possible. So for example, a lot of people who are moving on to green mortgages, whilst I'm a big fan of green mortgages, particularly if you're with that same bank, it saves you the hassle of moving. And obviously the only thing you need to do really is show that you have the relevant BER of B3 or higher. But if it's a case you want the financial security, particularly if you're likely to stay in the property for 10, 15, 20 years, then it might be worthwhile exploring whether or not you can get a mortgage with the likes of a van, which is only through brokers, by the way. You can't avail them directly. So it's like some of the previous questions, it does depend on a specific example, but the short answer to the question is 20 years.
Nick,
one question that, hello.
Sorry,
Hi.
it's Cleana here. There's
Hi,
a question that has come in, and it's just in relation to, it says, I've put money in cash FX via crypto and my money is trading on the foreign exchange markets. Am I getting a return of 4%, or I am getting a return of 4% a week? Does this sound too good to be true?
Well, they say, obviously, if it looks too good to be true, then there must be some issue with it. These types of returns are available in these types of accounts. But obviously, anyone who's earning 4% a week, and obviously extrapolated over the year, I mean, you can do the math on it, like that's over 200%. It will tell you that it carries a very high level of risk. There is no guaranteed return outside of 0%. So anyone who's been offered over 0% per annum must be aware that they're taking a level of risk that is categoric. So, you know, that in itself, I suppose, would answer the question.
Okay, there's another one here as well. I'm in my second year of a mortgage and it's a 3-year fixed. Can I move without a penalty for a lower interest rate, paying 3%?
That's a really good question. So the key thing I say to anyone who has a mortgage, and if they're on a fixed rate, is I ask them to do one thing, and that's to contact their bank and find out what the cost of breaking the fixed rate is. So for example, some mortgage holders out there who have a mortgage with KBC or Ulster Bank, who are obviously leaving the Irish market, they will be correct in saying that their mortgage will not be affected when they move to a new bank, which possibly could be Bank of Ireland or PTSB. However, what I'm saying to these people is that they should contact KBC or Ulster Bank and find out what the cost of breaking is. And it's the same with any institution. And it could be zero, or it could be a few thousand euros. Without knowing the answer to that, there's no way of being able to give any form of opinion. You might be surprised, but a lot of the banks are offering quite low breakage costs. And on that basis, what I'm saying to people is break the fixed rate, particularly if it's zero, go onto the variable, and then you now have the ammunition to be able to move or refix with the same bank and do it sooner rather than later, because as I said earlier, rates are going to increase.
Okay, there's another one then. What's the longest fixed rate mortgage rate available currently on the market?
It's a question that very similar to the one I've just answered. So the short answer to the question is 20 years. But again, whether or not you should fix for that level of mortgage rate would really depend on whether you're likely to hold onto the property for that length of time. If this is a property that you're likely to sell within the next 3 to 5 years, you have no real rationale for fixing for such a long term.
And then another one on cryptos. If you were willing to gamble on cryptos, what's the minimum investment, please? And could you give an estimate on amount and time for return?
I'm going to repeat what I said earlier. I would really warn everybody on the call to tread very carefully when it comes to cryptos. I know there's a lot been said about how much some people have made. I can say from personal experience, I invested money in cryptos in 2017, and I made a significant return from it, more by luck than judgment. And I also invested in November last year, and I've lost a significant amount on that proportion that I invested. Bearing in mind, there is tax on cryptocurrencies, and some people are slightly unaware of the fact that there are tax implications, on top of the fact that I would say to people, as I said earlier, take the highest risk in the longest term that you can invest for. So if you're taking a 20-year view on things, then yes, I have no issue with someone investing in cryptos, but that is really the time frame that I'd be saying, because if you're investing for any period less than that, you're in the speculative market, and you may as well just go down to Paddy Power. and put a bet on the 330 in Kempton.
Okay, there's one more here around pensions. So how much of a pension pot should I aim for, and what percentage of my salary should I be looking to invest in my pension? And then it just also kind of follows on to say, if an old pension from previous employment, what should I do with my pension?
So I'll break that up into two. So the general rule of thumb really is, and again, it's obviously age dependent, because if somebody's starting a pension at 50 years of age, they're going to have to play catch up. There's certain, I suppose, limits to what you can put into your pension. Generally, it's dependent on your age and your earnings level. But the general rule of thumb that I would say to everyone listening to this is 10% of your salary should be contributed to a pension. Now, for someone earning 50,000 euros a year, you might say, Christ, Nick, that's 5,000 a year. Seems like a lot of my salary. But obviously, on 50,000 a year, you're paying tax at 52% on anything over 36,800. It's a vehicle to reduce the tax that you pay. And bearing in mind that that 5,000 euros, you get 40% back from revenue pretty much immediately. That means that costs you 3,000. Now, if you're in a situation where your employer is contributing to the pension, that eases your burden. So if you're fortunate enough to work for a company that pays, say, 5% of your salary, then that enables you then to put in 5% also. But what I would say in that instance is, it goes back to what I said at the start of this webinar, which is make sure that you're balanced and make sure that you know where you're saving your money into which part, whether it be short, medium, and long term, and appropriately adjust those depending on your scenario. The second part of the question was, what should I do with the next pension scheme? The biggest problem I have is that people don't really have any sense of what they have from previous employments, and nobody manages it for them, because once you leave the company, you get forgotten about. We provide, again, a very simple service. All I ask of people is to sign an authorization that allows us to get the information on your behalf. We don't need anything else. We don't need people to go and find documents in a folder somewhere. Much prefer people not to. And we can then give you a sense of, based on what you have invested in the fund, show you projections as to when you want to look at drawing down the benefit. Doesn't mean retiring. People have this notion that we need to retire. I talk about being able to be in a position where you can take work a bit easier, or not necessarily work long hours or change career. And that's what I refer to this financial independence. And that could be at 60, could be at 55, could be at 70. It can vary for individuals, but you need to have a plan.
Okay, there's another question around the tax credit that you can avail of if you have more than 5,000 euros in investments. Does it become available as soon as you have the money in place? An example, investing 5K in December 2022, then trying to avail of the credit in January 2023.
So this question is referring to this tax back scheme that I mentioned earlier. Now, there would be information that you require. So I've only given you a very brief outline on this call. And again, I'm more than happy to share more information. I've been a financial advisor for over 25 years, and I have extensive working knowledge of this scheme, the EAS scheme. You can look it up on the revenue site. You can send on the link. But yes, it is possible to invest in the calendar year and get the tax relief. So on that contribution of 5,000 euros, 2,000 would be repaid back by revenue very early into the following year. The criteria for that has loosened. Pascal Donoghue mentioned it in the budget in November last year, that the criteria to get that relief has now been really simplified. And this is where, working through a broker like Alpha Wealth, we can explain the process and show you how it can benefit you. But it's not without risk. As I said earlier, there is no free lunch. If anyone believes that they can make money without taking risk, then they haven't been listening to what I've been saying for the last half an hour.
Just one other question then. This person says that they have money and they're just wondering, they have some money, but they're just wondering whether it would be good to pay off their mortgage or to invest the money in their pension. And what would you recommend?
There's kind of two aspects to this question, because I can talk very cold and hard about financial decisions and what's financially sensible. And generally speaking, if you have a mortgage at circa 2%, which is what we help our clients achieve, it really wouldn't make sense to pay down your mortgage in lieu of putting money into your pension scheme, because your pension scheme attracts tax relief of 40%. The pension fund goes tax-free, and when you draw it down, you get 25% of it tax-free, and the balance you can draw as it suits you, typically paying tax only at the standard rate, the lower rate. However, psychologically, some people don't like having mortgages, and it depends on your age, it depends on how big your mortgage is, and it depends on your mentality. There's no point me telling somebody to put money into a pension if they don't sleep well at night because they have this mortgage debt hanging over them. So this is back to this balance. It's about finding the right balance between what is financially sensible, what they can live with, and that they can see the benefits. The biggest problem with people with pensions and saving is they can't really see it tangibly because they don't feel it. And only by really getting these projections that we provide, whether it be for a savings plan or for a pension, can you really get a sense of why it's valuable. And then that might help you adjust what you're doing in these different areas.
I think that's it in relation to the questions that have come in.
Very good. Well, I'd like to say, firstly, thank you, Cliona, for coming in, stepping in and saving the day. I think people were getting a bit tired of listening to my voice. Thank you very much, everyone, for listening into this. And as I said, if anyone would like to get any further information on any aspect of what we've covered today, or indeed would just like to avail of the complimentary 30-minute review that we're providing on Zoom, which I caveat is available until the end of June. We will be charging €99 plus VAT from the 1st of July. And it's really just checking in and seeing where you are, and whatever aspect, how trivial the question is, there's no hard sell. We have a very, very, efficient team working in Alpha Wealth, and we just want to help you do better with your money. Please check out our website. There's some really good tools and videos that you can access. And indeed, follow us on our Instagram page, where we're doing a number of these webinars, and we're going to be offering you the opportunity to get more information, particularly on things that you may not be aware of, like the EAS scheme that I spoke about this evening. Thank you very much again, everyone, and I hope you enjoy the rest of the week. And as I said, we'd be more than happy to share the information and indeed the video. If anyone would like that, please do feel free to reach out to us and we'll send it on. My email address again is nick@alphawealth.ie, and I'd look forward to speaking to you then. Enjoy the rest of the evening. Thank you.